Hello, everybody. Welcome to Thursday. Unfortunately, S&P 500 was down 1.2% today. It started off well. Markets were up for the most part, and then it started to fall. And the buy the dip people came in and rallied it back up. Didn't quite get all the way back to even. And then it sold off at the end of the day, unfortunately. And so, we keep having this kind of buy the dip group coming in, and it's really not working out. And that's because the pressure of the situation is bigger than can be solved by this buy the dip group. And there's lots of different issues. We've talked about them lots of times, but of course, the biggest one is the debt default. This is a scenario where if you go back to last year and we had the pandemic and the market fell a lot, we had a couple things going for us. And I talked about these extensively. Number one, Congress was pumping out money. It was roughly $10 trillion that came out last year to kind of support the economy and consumers. And eventually that came into the stock market. And then you had the Federal Reserve moving interest rates down to nearly zero. Right now, we have a situation where this debt default is actually just the opposite of Congress coming together. It's Congress splitting apart into two pieces. And so, that isn't an area where all of a sudden we're going to see all kinds of money flying out of, possibly. But then secondly, we also have the Federal Reserve, instead of lowering rates, talking about cutting back on bond purchases and even increasing rates. So chances are that we're not going to have a default, but the chances are, unfortunately, that we're going to get fairly close to that October 18th date before it happens. And so anybody who has any understanding of what a default would mean to the economies, the world economy, the stock markets, is starting to take risk off the table just in case. And so that's what's happening right now. And the Federal Reserve has something called the reverse repo auction. And this is a place that large institutions are allowed to park money and get a small rate of return, kind of like putting money in a money market at the Federal Reserve. And they had a record today, $1.6 trillion came in. And so what's happening, of course, is everybody who's managing money is looking at this and saying, hey, just in case, we're going to take some money off the table and take some of the risk off the table. And that's exactly what we're doing. We made a change on Tuesday. We moved a few of our targeted indexes into ultra short-term bonds. That's worked out really well. We made another change today and moved the rest of our targeted indexes into ultra short-term bonds. This is not something I normally do, but a default is something to pay attention to. And besides that, even the threat of a default might bring the market down even farther, give us a chance to take those short-term bond funds that will generally hold up, hopefully, and then we'd come back in and be able to reestablish that same percentage of stock for everybody, and maybe get some better pricing and what have you. So, for example, our 100% stock portfolio is currently at 73%, and the other money's in these ultra short-term bonds, and it usually our 2% is in money market also in our model. So the changes that we made were in the IRAs. So the taxable accounts, we're looking for pieces that have a loss or a small gain. There really just isn't much. I mean, that's a good thing in a way. As I'm going through these, a lot of these pieces that we have are up 50 to 140% since we purchased them. So, if we sell some of those to try to get more conservative, it creates a huge tax problem. And that all of a sudden there's this big capital gain that comes out, and that's a known loss. We're going to lose money on that taxes. So really kind of buy and hold on that section, hunting for those areas that are, available to move. There's just not that much. Again, I guess that's a good thing in that regards, but IRAs and Roth IRAs, we don't have that problem. We're able to make these changes. So when I'm talking about this, that's generally what I'm talking about here as far as that goes. So very interesting time frame. Definitely, something I think we can take advantage of. If there continues to be significant deterioration beyond this, then certainly we'll make some more defensive moves as far as that goes. We are hitting some points right now where the support level is kind of eroding, and we probably could fall a little bit more to get down to the next support level. So that's something that, I'm watching for all the time. And honestly, this is when, people like me are valuable, I think, because we can come in and help with these scenarios on a custom basis. We're not looking at everybody as one giant client like a mutual fund might. I mean, I have 270 households, 270 different stories, and really we try to customize the situation and deal with everybody, for what they need as far as that goes. So I appreciate everybody's trust here. I think this is going to be fine. Don't worry too much. We have a plan. We are on top of this right now as far as that goes. And again, I suspect that the debt ceiling will be raised. And and that as it falls before that, maybe that gives us some opportunity to get back in there and get some good holdings. So this would be a great week if you want to join me for the Talk Money with Tom show that we have every Friday from 12:15 to 1. This show is designed for you as clients or non-clients to just say, hey, what about this and what about that? And you can email in your questions, ask Tom at talkmoneywithtom.com. There's a chat box that we have now, so you can sign into your YouTube account and put your questions in the chat if you'd like. So it's a really good event. I really enjoy it tremendously, but would be a great week to join. There should be some questions about what's going to happen here and how we're going to deal with this. But anyway, I look forward to talking to you about this tomorrow. I do a summary of what's happening in the market for the whole week at the beginning of that show. So look forward to seeing you then. Thank you very much.